All right, good morning to everyone. Thank you for joining us, the Alliance of Angels with Volition, for our webinar on Investor Readiness Bootcamp. We're privileged to have Paul Brassard delivering our session today. He traveled all the way from Vancouver to share his presentation with us, so it is much appreciated. Just some quick logistics. This is a open Zoom meeting, so if you have any questions for Paul along the way, feel free to jump in, participate, have an interactive session so we can all learn together. But that said, also, I do ask that if you are not speaking, please put yourself on mute so that we have a quiet experience and everyone is able to participate in a positive way. Okay, so I'm going to, and again, right, a reminder, if you are not speaking, please put yourself on mute. That'll be much appreciated. All right, I'm going to share a few words about Alliance of Angels. This is the organization that I am with. My name is E. Jane, and the Alliance of Angels is an angel investing organization here in Seattle. We've got 140 angel investors in the group. Every year we put about 10 million into 20 companies. Right. Most companies that are fundraising from us, they're looking for a total between $500,000 to 1.5. And our typical check size is from 250 to 500. Right. We are a sector agnostic investor. Although about half of our investments are in IT, a quarter are in consumer, and the rest is in life sciences, hardware, energy, etc. But our focus is principally on the Pacific Northwest, regardless of your stage and regardless of your sector. So please feel free, if you are interested in fundraising from my group, feel free to send me an email. My contact information is at the bottom of this slide. And if you are maybe an investor and interested in learning more about my organization, feel free to reach out to me as well. Okay, and with that, I'm going to stop talking. I'm also going to stop sharing, and I'm going to hand the session over to our speaker for today, Paul Brassard. Paul, please take it away.
Awesome. Thank you very much. I will share my screen now. I love the comment of flying me in to do this. I think you said traveled all the way. So yeah, thanks to Alliance of Angels for flying me virtually from my one desk to another desk in my office to do this presentation with all of you. So welcome to the Investor Readiness Bootcamp, and thank you to Alliance of Angels for having me here with you guys today. So just go ahead. Yeah, okay. Did you need to say something?
Nope, not at all. I think there was just some feedback. And again, please, and Paul, just also do also share a little bit about yourself and the services that you provide. It's very common and standard for our presenters to share a little bit about their business.
That's what I'm doing right now. Yeah.
All right, wonderful.
For sure. Yeah. Well, just to confirm that you can see my screen, right?
Yep.
Okay, perfect, good. Okay, so yeah, so again, my name is Paul Brassard, and so I am a 20-year entrepreneur, 20 plus year, I guess now, entrepreneur, with about 15 years of pitching and fundraising experience. I am a master pitch and presentation coach on my kind of day-to-day. I work with companies and startups on a consistent basis to work and prep them. Now it says master pitch and presentation coach. I specialize in investor prep and investor readiness. Essentially helping companies make sure that they're ready and prepared to fundraise, even if it's not just from investors, but from other groups as well. So I am a co-founder and managing partner and lead advisor at Volition. I'll talk a bit more about Volition in just a moment. And then I'm also the COO and co-founder of a company called Straws and Stuff, where we recognize that you can't change human behavior overnight. So we're changing the products that restaurants and cafes provide to customers with fully biodegradable from nature back to nature products, such as straws, utensils, packaging, etc. And then I'm also the COO and co-founder of a company called Bucky, in which we are building an NFT assets platform that we are using, building a mobile game as our vehicle for play to earn NFT rewards. I'm not going to go too deep into that one because some of it is still sounds really corny, but it's a bit stealth at this point. So that's a bit about me. So in terms of Volition, at Volition, we believe that ecosystems are made stronger when there is collaboration connectivity and capacity building opportunities. So we do just that. We work with programming partners all around the world. We've done things like launching a women's entrepreneurship program in Albania. We recently launched an investor readiness program in Kenya. We're working on a women's entrepreneurship program for the Kootenays. We work with some groups in the US. We work with groups in Canada and all over the world. Actually just worked with a group out of South Korea involved with LG as an innovation group, and get to do a lot of really cool work there. So we do the programming, we design, develop, and deliver. We also run events. So we've run over 100, and I think it's actually almost 120 pitch events now, in which we do on a regular basis with partners. And I am also one of 13 coaches and growing on the team that provide one-on-one services, from anything from pitch and presentation to sales, marketing, onboarding, customer success, valuation and due diligence, and so on and so forth. Pretty much anything business related. When it comes to startups, we have a lot of very talented and experienced coaches on the team working in the startup sector. So if you ever need help, you can definitely reach out, and we are happy to help you with whatever you need. So I'm going to head straight into it. So one of the big questions that I often hear really is, should I fundraise? And I know you guys might be sitting there going, well, but Paul, we're at an investor readiness bootcamp. You know, I kind of am thinking that I'm already raising, but that's actually why I want to bring it up. And I don't, hopefully this isn't going to offend anybody at Alliance of Angels, but I mean, at the same time, we don't want anybody to waste anybody's time. And so why I wanted to ask this question, and I encourage everyone to even ask themselves, is, should I fundraise? Here's the thing. I incur a lot of entrepreneurs. I actually just had one that I worked with about a month ago. They were actually out of Ontario. And as I was working with them, they asked me about fundraising preparedness, where we're going through all this stuff. And as we went through their business, I said for a moment, I was like, is there really a reason that you have to fundraise? And the entrepreneur came back and said, well, don't I have to? Isn't that what I have to do as an entrepreneur? And getting down to the dollars and donuts of it is they actually thought that they had to, that it was a requirement. And so as we went through their business, we realized that in actuality, they actually had a business that was much better being built based on growing their revenue. They were predominantly per revenue. They had some early revenue, but they had potential to get more customers and actually get that business growing through that way, and actually growing it through revenue, and not necessarily a great business to go out and pitch to investors, because there'd be a lot of questions. They'd probably need to get a lot more traction to grow their leverage first. So it's the difference between, you know, can I build my business through revenue, through, you know, doing that route, or should I actually go get funds from an investor? And when we put ourselves into the investor's mind, I mean, there's a big difference between having a business that you're pitching to an investor that's really kind of still like fluffy clouds and idea stage, you're kind of pre-launch, pre-rev. Yeah, you can certainly pitch it. And there are definitely stories of people fundraising just on that alone. But I will say it makes your job a lot harder when you don't have any kind of, I'm going to call it, for lack of a better term, I'm going to call it proof in the pudding. So I encourage everyone to give themselves a real talk about, should I fundraise, or should I maybe build this through revenue? I was just working with another client a couple of days ago. I think it was on Monday. And we were sitting there and they're talking about, yeah, we're building this business up. We've got, and if, listen to what I say now is like, they're sitting there telling me, oh yeah, we've got a whole bunch of customers that are extremely interested in our product. We've got a prototype ready. We've done testing. The product works. They love it. They want it. There's a huge demand for it. So we're going to raise $2 million and try to get it out there. And so I just said to them, well, hold on, you've got all these customers, and the type of business they have isn't really a traditional investable company. It's also a very deep hardware company, so very complex systems. And so I just said, like, you've got all these customers at the ready. Why don't you get them to pay deposits and build yourself through sales? And then once you've got those letters of interest, those purchase orders, you can go get financing. And even if you do want to talk to investors at that point, it probably makes your conversation a lot easier, because now I'm not investing in kind of the dream and the vision, but rather now I can put money into something where there's an actual viewable goal. Okay, that if I give you money, you're going to use it to make inventory, you're going to sell the inventory, and we're going to grow the business. So it's a difference in the conversation. And so I encourage everybody to have that conversation with themselves and really decide, is this what I really want to do? Because let's be real, fundraising, I'm just going to be real with you for a moment. Fundraising is a pain in the butt. And again, hopefully Alliance of Angels doesn't get mad at me for saying this. But again, I've been doing this for a long time. And what I can tell you is that I know that it takes a lot of energy, time, and bandwidth, generally speaking, to fundraise. Generally, obviously, depending on the size of the round, but almost in any size of a round that you're doing, it's going to take 3 to 6 months at least. And there's a lot of preliminary, there's a lot of paperwork, there's a lot of stuff to do. And it honestly actually really is a distraction to your business. It's going to take you away from running your day-to-day, from doing the business. And at the end of the day, you have a business to run. So sometimes you have to decide, should I spend the energy on going and getting sales, building revenue, building leverage, building value, as opposed to spending my energy on trying to fundraise, thinking that might be the easier route. But honestly, the easier route is if you can build up the sales first and then go to an investor and say, look, I've got this, this is where I'm going. This is my plan. This is what I'm going to use the money for. Now your sales conversation with an investor is much, much simpler. So should you fundraise? Well, again, it depends. It really depends on what you decide the purpose is. And so I have, as I said, I've worked with a lot of entrepreneurs over the years, and I hear a lot of different reasons, and some reasons are good ones, and some aren't great. I've even heard answers of like, well, we want to just get an office, or we want to do this, or we want to do that. And it's not really concrete reasons to fundraise. At the end of the day, an investor doesn't want to pay your law bills, right? Like I've actually even seen that before many times on pitch decks, for example, where people are like, yeah, we're fundraising 200K and 50K of it is to pay for our legal fees. And it's like, excuse me, I'm sorry, but as an investor, I don't want to sit here and be paying your legal fees. That's not my purpose. My purpose is to put money into your company. And remember, the purpose of an investment is for a return on investment. So really, I want my money to be put to work to achieve something that's going to propel the company, that's going to move it forward. So the things that really investors love to hear is how, and not just hear, but this be the truth. Like you're not just telling them this for the sake of telling them, but what they really want to know and hear is ultimately what your plan is to execute and how you're going to execute the plan. So ultimately, is the money for some form of scaling? Is there a vertical scaling opportunity, a horizontal scaling opportunity? Where do you take the company from here? The second is for growth. Maybe you need particular team members. I see this all the time. This is a great reason. I was just working with a client the other day where they're like, look, I've been on my own. I'm the CEO. I'm doing the sales. I'm doing, marketing management. We've got a part-time marketer. We've got a part-time salesperson, and we've got a couple of engineers. We've got some customers, but we want more. We've proven this out. We want more customers. We need to bring our marketing and salespeople full-time. We need to hire a couple more people. And just doing that alone, we hit these KPIs and goals, and we can increase our revenue from 300K to 2 million. And it makes a big difference, right? So that growth, now that's a much easier conversation as an investor for me to get behind, because I can be like, oh, okay, so you're going to take my money and you're going to put it to work. You're going to have it achieve something. You have a goal, you have a plan with it, as opposed to being like, you know, something I hear quite often is, oh, we're raising 250 to 450K for sales, marketing, and R&D. Okay, but to me, that doesn't really sound like a plan. That sounds to me like you're just going to take my money, kind of throw it into a hole, and hopefully a money tree grows out of it. But I think we all know that that's not how it works. We really need to think about the purpose of those funds. What are we going to do? What are we going to achieve? What's the plan to execute? And how do you execute the plan? So scaling, opportunities, growth, so team growth, that kind of thing. And then, you know, it obviously depends on the type of business. I mean, if it's a software company, you're going to be engineering, developing, doing all that stuff. So your growth, it might be more in your growth in terms of hiring more developers, engineers, whatever you need there. But some businesses, of course, maybe you need money for inventory, and that's okay too. Maybe it's like, yeah, look, we've got 100 customers lined up, but we need cash to manufacture the product and fulfill the orders. Once we fulfill the orders, we'll triple our bottom line revenue, or whatever it might be, right? Whatever that story is. Numbers are variables, so whatever they are to you, you can obviously replace those for your business, because every business is slightly different. But ultimately, there should really be a purpose to your fundraising. It's a much easier deal for investors to get behind when we know how the money is going to be put to work and what it's going to achieve. I understand. Let's be clear between you and I, you know, don't tell anybody else, but I understand that none of us have a crystal ball. I get it. But we can at least still have a plan that we're working towards. And yeah, we all get it. Even investors get it. Not everything goes according to plan. But I'll tell you what, the big difference, if I'm looking at multiple companies a week, which I know most angel groups and investors are looking at, you know, call it 5 to, generally, I think it's like 5 to 25 companies a week. You know, if it's the difference between a company that gets in front of me and says, yeah, here's what we've done, here's what we're doing, here's what we're going to do, we have a plan, and this is what we're going to use the money for, versus, yeah, we're thinking about doing this. We are probably going to launch in the new year. We're probably going to grow our sales like this. We're probably going to do that. Again, even as I say that, most of you are probably like, well, I think I kind of know the answer of which one I would steer towards, because generally speaking, most investors are not looking to invest in fluffy clouds and dreams. So some other decisions you really need to take to heart, because this is something that I incur a lot as well with entrepreneurs that I'm working with, is not even realizing the implications necessarily. And I'll be honest, when I first started my career in startup and tech, it started with poker on Facebook back in 2006-ish. I hadn't fundraised before that point. I had no idea what I was doing. I just was kind of thrown to the sharks, as it were, and had to kind of learn all of this. And, you know, I didn't realize necessarily the implications of everything that came along with it, recognizing that you are giving away a portion of your company, and that you shouldn't just be frivolously passing that around and giving it to any investor who expresses interest. You really want to make sure, again, that not only are you okay with giving up a piece of your, let's call it your baby, because that's kind of what it is. Are you okay with giving up a piece of that? And yes, you're getting money in exchange, but is it the right money? Is it the right investor that you really want to work with? Is it somebody that you can communicate with? Is it somebody that you want to do business with? I always look at it this way: is this somebody I would want to do business with? And I have a rule of thumb of I don't work with, I was going to use a bad word, so the A word. I don't work with A words. So I have some rules, and that makes it easier for me to filter out. So you really have to decide, are you okay with giving up that equity ownership? Because again, if you can go the other route and build up for sales, let's also remember, if you go the other route and if you're able to build up sales and revenue and value, when you do raise, if at some point you're going to anyway, but if you can kick that can down the road a little bit, it's even better for the investor, because now they've got an even more, again, proof in the pudding business that they're investing in. But also you're increasing the valuation of your business, which ultimately means that you ideally will give away less equity in exchange for that cash. So that's why I always question, like, make some decisions. Can you get customers to pay in the meantime? And again, this isn't to deter you from going to great groups like Alliance of Angels and many of the other great angel groups and early stage VCs. It's not to deter you, it's to make a better deal. That's what we all want in the end. We all want great deals. We all want success. We all want returns. Yes, it doesn't always work out that way, but I'll tell you what, if you can kick the can down the road a little bit and focus on getting those sales, you're only going to validate your business more. You're going to actually make it easier for yourself to fundraise, and you're going to make your whole path a lot easier. Now, sometimes though, I've got a question up on the screen that says, how fast do you need to scale? Sometimes, admittedly, there are just these ones that are real moonshots or Mars shots, whatever you want to call them these days. I heard somebody recently call a Mars shot, where basically, you're going to do it and you either land it and it works great, or the business dies and that's all there is to it because it couldn't survive on Mars. Hopefully you all get the analogy, but ultimately, there's some businesses that are just like that. And I'll admit, I mentioned my company earlier, Bucky. It's in the NFT crypto space, and I'm learning a lot. I am by no means yet an NFT crypto expert, but I've learned a heck of a lot over the last 3 months. And the pure fact that people are kind of just throwing money at us because it's NFT crypto, we're going to close probably a $2 million round like that. But we're also in a space where we kind of have to. We have to act now because the Wild West is open. It's time to go. As opposed to my other company, Straws and Stuff, we got some early sales. We took it slow. We've got, about 20 customers now. We launched sales in August. We got about 20 customers now. We're building up our revenue, doing about 5K a week now. And we raised 200K just to bring in inventory. That was it. The investors knew very clearly the money is for inventory. We're bringing it in. We're selling it. They're getting a royalty on the sales. It's a very simple deal, easy, but we didn't need to raise a whole boatload of money to scale it up quickly. So that's where we sat there. Sorry, somebody's just off. There we go. So you really have to decide what's kind of the best plan and strategy for your business and why you're really doing it. Now, some things that you're going to need along the way, if you don't have this already, I recommend that if you're planning on going out and starting to pitch, I generally recommend that you have a short form pitch deck. With that, you use that for 90-second to 2-minute pitches. Then you have a long form pitch deck, which is about 5 to 10-minute pitches. And then what I usually recommend is that you have a slide deck, which is the one that you send to people. So of course, very simply, the pitch decks, of course, are more image driven, less text, less context, because you're there to support them. Whereas the slide deck, often what I'll say is the slide deck is a summary of your executive summary. And so it will have a bit more text and context because you're not there to support it. And ultimately, I have to tell you that time and time and time again, really know your story. There is something, there's a psychological element to it, and this isn't a pitch and presentation masterclass, but in my pitch and presentation masterclass, I do talk a lot more about the importance of the story and why it works and all of that stuff. I'm not doing that part today, but I do need to tell you, it's very, very important that you connect with your story and you know your story and know how to tell your story, even to investors. There's a revenue story, there's an entrepreneurial story, there's a problem and solution story. The whole thing you're building is a story. And very simply, you know that story. The story is that, I was doing a thing happened, I created a solution for the thing. So then I had people tell me that they would be willing to buy the thing. So now I'm raising money to make more of the thing to sell, and I need a team to do it. You really need to connect to your story, and there needs to be that why element. So, I know it sounds cliche, I get it, but I've become a real avid believer of, and I see it time and time again. As I said, at Volition, we've run over 120 pitch events, and that's just our pitch events. That's not including the other pitch events I've taken part in some regard, whether as a judge or mentor or whatever it might be. But we hear it time and time again, even in the deliberation rooms, in behind the scenes. I just did an investment summit last week, and in the deliberation room, part of the conversation with the investors, they were kind of between 2 to 3 companies. There's 5 companies that pitched. They were between 2 or 3 to win the whole thing. And part of the conversation was, well, this one's story though, they really knew how to tell the story. We got it. We get where they're going with this. We really understand what they're up to, what their plan is. Whereas this one, it didn't relate the story as much, but the business implications are great, but it looks like it's a much longer investment thesis. Like the return will be much further down the line. And there was a lot of conversation, but the story element keeps coming into it. And what I'll say is that story piece usually tells why you're doing this. Again, it's going to sound cliche. I get it. But I do hear this all the time, which is why this, why you, why now? A simple way of telling a story is to answer those questions. So I or we are the right people to do this because, and here's the reason for that. I know many investors that will sometimes say, look, I looked at 5 companies yesterday. Let's just say I've had conversations like these. Yeah, I looked at 3 or 5 companies yesterday. And one had a really strong business thesis. I really liked their business model. I really get it. I could see them going places, but they're still very early in their journey. I'm pretty sure they can do it, but they're pretty early in their journey. I'd like to see them get some sales first. The second one's like, I loved this team's story. I love their pedigree. I like where they're going. They really had a plan. And you know what? I really believe in the team. I'm not as sure about the business model, but you know what? I really believe in the team, and I think they'll figure it out. What's amazing is a lot of people will actually say, oh, well, you obviously you would invest in the one that has a stronger business model and they've got it figured out. And even though they might not have started to get the sales yet, you're pretty sure. But actually, the one that time and time again I see investors go with is actually more with the team. Because at early stages, we're not talking about Series A. This is a conversation with Alliance of Angels, right? So we're not talking about Series A, Series B, Series C, financial institutional funding. We're talking about early stage funding. And realistically, at early stages, generally speaking, we're going to invest in the team and the people a lot of times, sometimes more than the business itself. Because what we want to believe is that the team is going to have that figure it outness to figure it out when things get tough, make the small pivots, make the smart decisions, communicate, figure things out, learn, react, iterate, and do all of that stuff, and really be a strong team in that sense. And so we can believe in the people. So it's more that we're investing in the people rather than necessarily the business. Now, I mean, yeah, the business still has to make sense. And for a lot of investors, they'll still say it has to be something that interests me. But let's be real. We all in this room probably know this. Building a business is hard. And so again, part of the de-risking of this as well for an investor, because that's part of this too, is de-risking the opportunity. You know, I also want to have a good sense that when the going does get tough, and it will, because it always does, building a business is hard. You know, so when the going does get tough, you know, how are you going to be resilient and persistent and get through it? Well, it's more often than not, it's going to be because you're connected with it through your why. Why are you doing this? What is the passion point of this, of why you're doing it? And we're really looking for that in the people and the teams. The other benefit of this story is it's a great strategic hook. And like I said, I talk about this more in my pitch and presentation masterclass, which maybe Alliance of Angels will bring me back for it at another time. But ultimately, having that storytelling capability and telling that story, it really draws people in. It helps them connect with you. You might even be able to do a story, depending on the type of business, you might be able to build in a story that builds that empathy. Or even, you know, a lot of times, some of the best ways I always think of it is like, if you can tell the solution from the customer's perspective, how did they use the product? What value do they get it? Or what is their aha moment? You know, telling that story can be very, very powerful and really brings people to have that view of what your product does or what the value is ultimately. So now, I've talked a lot about the story and things you should consider for yourself, considerations, questions, all of that kind of stuff. Here's some extra stuff that a lot of investors I've worked with, including myself, and investors that I know, they use, a lot of them will use the terminology of either ticking the boxes. I've even had a couple that use the term filling the buckets. It's kind of the same thing. You can put it either way. But ultimately, let's talk about ticking the boxes. So I'm going to do this through a sense of red flags, green flags. So a red flag that I hear and see quite often, we have no competition. And I know most of you in the room right now are like, oh my gosh, why would anybody say that? Or I would never say that. You'd be amazed. It happens more often than you would think. And it's quite incredible. I mean, we do a pitch event. We do about 2 pitch events per month. And I'm going to say it, probably out of 8 companies pitching, it's probably 1 or 2 out of every 8, to be very honest. It's very surprising. So the one thing we always have to remember, again, looking at it from the investor's perspective, what this tells me when somebody uses the statement, we have no competition, what that actually says to me as an investor is, somebody hasn't done their homework. It is extremely rare that you are going to be building something that has absolutely no competition. You're telling me there's no direct, or even at least no indirect competition. There's always alternatives, and at very least indirect. So there's always going to be some form of competition. So it's always best to include that. I'll use an example now of, I've got somebody off mute. I'll use it. There we go. Oh, thank you. I'll use an example. So I had a client that I was working with last year, I think it was, and they had a business that was similar, but as a niche of the Airbnb space. And she did her pitch with me, and the pitch was great. Don't get me wrong, the pitch was great, but at the end, and part of the pitch that she did. Again, it was a great pitch, but part of it, she did do a competitive analysis. But at the end, I said, okay, hold on. So that was fantastic, but I really need to address the elephant in the room. And I said, the elephant for me is that you are very clearly in somewhat direct competition, although albeit you're a niche, but you're very much a competitor to Airbnb. And I said, so I have to just ask, like, why you did a competitive analysis. So why wasn't Airbnb included? And the entrepreneur said to me, well, I was worried about including Airbnb because I felt like if I said it, then people would dismiss me right away because that's a giant beast and they would just automatically crush me and the investors wouldn't even give me consideration. And I said, well, okay, so here's the thing is that she's already, now this was last year and she had just launched like 8 months before that. And she was already doing 10K a month in revenue. So from my view, she was clearly doing something right. And so I just sort of was like, well, however, though, is actually you not talking about them as competition or why you're unique and better or different. I mean, you're getting customers. Not only that, your revenue is growing month over month. So you're clearly doing something right. So actually you dismissing it and not including it actually made me question what's going on and question the validity of the business. And so you never ever want to have the statement, we have no competition. What you really want to show is why you're unique, better, different. You know, who is the alternatives? Who is the indirect or direct competition? Again, I've talked about this before, but I just need to reiterate it because it's so important, which is no clear plan is a big red flag. You know, and this can even come through in your wording, which I hear this a lot, is in pitches, if you use the words if or we hope to. Again, just even try to change your language to we plan to or when we, right? Again, I get that we don't have a crystal ball. I totally get it, but it's better to have a plan than to be guessing or hoping, right? I don't invest in hopes and a wish. I invest in plans and people. Try to bear that in mind. The next one that is a big red flag is steamrolling. And I'm sure people at the Alliance of Angels have heard this many times before as well, where somebody comes in and they roll you over, bowl you over with information with no real substance. So it sort of sounds like something like, hi, my name is John. I'm building the greatest business since Wonder Bread. We're going to be doing $1 million by the end of the year. Our business is going to be worth $10 million and we're going to be $1 billion company in 3 years. And we're going to be so amazing and rich and famous and wonderful. And it's just going to be the greatest thing you've ever seen. You should invest in us today. And the whole audience just sits there going, I have no idea what just happened. I don't know anything about the business. And that was very forgettable. And I don't believe it. So that is a term for steamrolling. And I know most of you are probably like, that sounds ridiculous, but it does happen. I'm very much going to tell you that it does definitely happen. The last one is definitely uncoachability or no passion. And again, I know most of you are like, oh, really? No, of course, you know, but it does happen. Uncoachability. At the end of the day, remember, feedback is feedback. It doesn't mean you have to apply it. Everybody's going to have opinions. Everybody's going to have thoughts. Investors even are going to have their own perspective on how you should do things. And look, there is validity in listening to what they have to say because many of them have more experience than we do. You know, there's humility to being not the smartest person in the room, right? And sometimes we have to learn that humility. We have to go through the hard times to really learn, like, okay, I got to put my ego aside and remember that there are other people that might know more than me. Probably there are. And so there is some humility to that. Now, it doesn't mean you have to apply everything. I have a friend named Daryl who I love the way he says it, which is don't take feedback to heart, take it to mind. You know, try it on like a shirt. It might fit. If it doesn't, it's okay. But uncoachability sounds more like, yeah, you don't know what you're talking about. Or even sort of being dismissive about feedback and not even considering it. You know, at the very least, you can just say, okay, I'll take it into advisement, or I'll think about that, or thank you for your feedback, right? Coachability is a big thing, usually, especially for most angel investors I know, because a lot of them, sure, they don't necessarily want to be involved in the day-to-day. That's why they're investing. But a lot of angel investors I know, including myself, they want to be helpful where they can be. So they want to be able to provide feedback and input. You know, they want to, a lot of times they want to be like somebody you can go to and ask for help if you need it. Again, the idea, this is where this term, you've probably heard it before, is smart money, right? There is a semblance of importance to that, of bringing in the right people. I look at angel investors, any kind of investors, I generally look at them as like their team members. And yeah, they might not be active in the day-to-day operations, but it's somebody I can go to when I need help, or you know, maybe doors they can open, or just that knowledge. You know, you're part of the investment. Sometimes, I'll be honest, there's been investors that I've had over the years that their knowledge and experience and advice has been worth more than the check they've written me. You know, I've got one investor, for example, they invested a total in me in one of my businesses of $5,000. Not very much in the grand scope of things, especially compared to the other check writers. But I'll tell you what, the advice and guidance and knowledge that they've instilled upon me over the last several years, worth far more. So just kind of bear that in mind. Now, some green flags, things that we really like to see, and I guess I got to tie this up because I only had, I think I'm almost done. So you really want to show that you're knowledgeable about your unit economics. So you understand the costs as much as you can. I know at early stages, sometimes we can't know all the stuff, like, you know, you're not always going to know your cost of acquisition at the very beginning because it's going to be all over the place. You don't have enough data to actually average it out and know. But at the very least, is if you can get down to at least an idea that you understand your initial costs, how much it costs you, how much you sell it for, what your margins are, how much you need to sell to get to, say, break even, that kind of thing. The closer you can get to that, or at least identify that you are working on acquiring that information, again, just helps me to de-risk the deal and shows me that you're making the considerations, right? It shows me that, again, you're applying a plan. The next one is proof and or traction. And so here's the funny thing. I got people say to me all the time, but Paul, I don't have any traction because I don't have revenue. So something I want to remind all of you, traction is not just revenue, even in the investor's eyes. Traction is anything that propels your business forward. I often like to think of it this way. The way I usually explain it is, if you think of your business as a vehicle, the tires hitting the road in a vehicle is literally, by definition, traction. So in the same sense, for a business, traction is anything that propels it forward. So of course, it depends on the stage of the business. If you're relatively early stage, this could be things like letters of interest. It could be memorandums of understanding. It could be, let's say it's a mobile app. Maybe it's pre-signups. You know, any kind of semblance to show that you've got some sort of proof that people want this and you're propelling the business forward. That you always want to make sure you show that off. A quantified valuation, which I'll come back to in just a moment. And then clear differentiation from competition, a term that I hear quite often these days. It's funny because I heard it a lot when I was first starting out in the industry, and then it kind of went away and now it's come back again, but is the term moat. So what is your moat? Like a castle moat? How do you keep others out? How do you protect yourself? So of course, I know, I recognize not all of you are going to have patents necessarily, but even just what's your unique differentiator at the very least, or is there proprietary IP, things that a secret sauce that only you have? Is there some way that you can talk about that? Now, again, I know for patents, you can't obviously talk about the secret sauce because that negates the whole thing, but at a general sense, what is it going to do? And then you can say, and we're applying for a patent, or we have applied for patents, or whatever. Again, de-risks and increases the value of the deal. So this is just a quick overview of understanding your financials. I'm not going to do a deep dive in this. I've provided the slides to Alliance of Angels, which they will, I believe, share with you afterwards. And so you can obviously revisit this, but it's basically just to kind of give you an idea on your, what we call at Volition, your cocktail napkin economics, which is essentially just the important things generally for most businesses. Again, every business is a little bit different, but there are some definite things that you really want to try to keep in mind or have in perspective or acquire over time as you're collecting data, such as like your cost of acquisition. We should always know our burn rate, how much money are we spending per month, what our churn rate is, how many customers are we losing, all that kind of stuff. So I will, again, this is included in the slides. You can revisit it later. It's fairly self-explanatory, I believe, so that when you revisit it, you'll know kind of what's going on there. The other things I want to just remind you of is that make sure you always have an ask. If you want to be an entrepreneur and not a wantrepreneur, you always have an ask, and don't be afraid to ask, because if you don't ask, you don't get. Just whatever it is your ask is, be as specific as possible. We're looking for connections to these potential clients. Say who your dream customers are, or we're looking for a business advisor. We're looking for a marketing advisor. Even better, we're looking for a marketing advisor with 10 years of experience in two-sided marketplaces. Right? The more specific that you can be about it, the easier it is for anyone to be able to take action. I'm going to finish off on this note, or a couple of notes, is something I hear quite commonly is, I'm looking for a VC. Well, or I get asked, can you connect me with a VC? So I just want to make sure that everybody understands the difference. So angel investors generally are investing their own money, and therefore it's their risk. So they tend to invest in more early stage companies, and that tends to be the case. VCs, venture capital, it can be their money, but it's generally other people's money. It's a fund, and they have an investment thesis that they have to follow, and they have to reach certain requirements. So they literally, most of the time, cannot invest in your business unless you're doing $700K to $1 million in revenue. They just literally can't, because their articles state that they cannot. The reason for that is because it is a fund and they need to meet certain criteria. Ultimately, it's a whole calculation, and they have to have X amount of businesses in a fund reach, that billion-dollar status to get enough distribution to the other shareholders in the VC LP to make it worth it for their return. Whereas angel investors, it's smaller check sizes, it's their money, their risk, generally speaking. And so they invest in earlier stage businesses. So my point here is, if you're at earlier stages, you do not need a VC. In fact, I would encourage you not to necessarily waste your time, because a lot of times you're going to get people that are like, they are a VC and they'll say, oh yeah, I'm interested, but get back to me when you're further down the line. Or it sounds super interesting. Oh, for sure, yeah, it's really cool, but I can't invest in you, right? And it's just going to end up in useless conversations. Maybe you make some good connections out of it, but really focus where you need to focus. Business is hard enough, and then there's no reason to waste time where it's not needed. So again, this slide is in the slides, which are provided to you, but it just breaks down kind of the levels and stages. And then just as some additional stuff, I've included some information about valuation techniques. I just want to say very quickly that at early stages, valuation, what I've learned over the years, it's kind of what you make it, as long as it's quantifiable and reasonable. Because unless you have revenue basis to go off of, unless you have a bunch of metrics to go off of, it's hard to build a specific exact valuation. So there are some methodologies, but at early stages, you can sort of make it up to an extent. One of my previous companies, each of the founders put in 300K. There was 4 founders, gave us an initial value of 1.2. We did about $1 million worth of work on it, built a team, built proprietary technology. We made the valuation 2.3 on our first raise. Very reasonable. We raised 350K on that. And it was simple. Did we have it based on anything? No, we didn't have revenue. We didn't have customers yet. But we were able to quantify our reasoning behind it. So there are some methodologies, but depending on what stage you're at, they may not all be applicable. And last but not least, I also included this for those of you who are going to be fundraising. This is some basic information to include in your deal room, whether it be in a Dropbox or Google Drive, to help you build up your due diligence deal room. And with that, I'll open it up to Q&A.
Yeah, I think we have a question in the chat.
Yes.
It's about your organization.
Let's see here. Does your organization provide mentoring advice independent of fundraising? Thanks, Isaac. Yes, we do. Yes, absolutely we do. We provide coaching services, so advisory coaching. And just to be very clear, the difference between us and a consulting firm, consultants, a lot of times they're very individualistic, but also tend to kind of steer towards doing the work for you. We're very much advisory coaching, which is we really follow the methodology of teach a person to fish. So we're really about guiding, coaching, teaching people through the process so that it builds their value and they can understand what it is. So independent of fundraising, yes, we also have coaches that help with sales, marketing, onboarding and customer success, pretty much any business function in a startup that you can think of, financials and projections, et cetera, et cetera. The only thing we don't do is tech advice yet. And we don't do like legal or tax advice because that's actually illegal for us to do.
Thanks. And so for the benefit of folks who want to follow up with you, can you paste your email or your preferred?
Oh yeah, I hadn't got there yet because I was doing Q&A first.
Yeah, if we could just put it into the chat, I think that might be easy.
I've got it here.
So it's paul@volitionadvisors.com.
Yep.
For anyone who wants to follow up more information.
And my ask of everybody here, please connect with me on LinkedIn. I love following people's journeys, helping wherever I can. Just to include a message that, hey, saw you at the Alliance of Angels talk, or just give me some indication of where you saw me. But connect with me on LinkedIn. Happy to connect. And then you can also, like I said, book me through my Pick My Brain profile there and check out our social channels. We've got some amazing YouTube content, a lot of interviews and past pitch competitions and stuff like that for you to check out if you'd like to.
Great, thanks. Does anyone else have any other questions? And you can, this is an open Zoom meeting, so people can speak up if they would like, and don't be shy. Or if you prefer, you can also put something into the chat window that's currently open. All right, so just going once, going twice. All right, I think your presentation was so watertight, folks are speechless with your. Thank you.
Well, they might be still digesting the information. So yeah, so by all means, like I said, connect with me on LinkedIn. If you've got any follow-up questions, shoot me a message. Happy to help however I can.
All right. Thank you. Thank you very much, Paul. Thanks for spending time with us this morning and sharing all your insights and thoughts. It was much appreciated.
No problem. Thank you. Thanks for having me.
Right. Thank you. Everyone, have a great rest of the week. Thank you.
Take care, everybody.
Thanks. Goodbye.